Well, today I want to go over some trades on these underlyings today. So I want to go over some trades on XLK, QQQ, IWM, KRE, XLF, Wells Fargo, and PayPal. And so I just want to go over trades in those. If you're here for some trades in Wells Fargo or PayPal, you should probably go to the end of the video. It's going to be later on towards the end of the video that I'm going to talk about those. But first, I just want to start to talk about what's going on in the macro. People are totally confused about what's pushing this market up. What most people don't know is that currently we're in a situation where we have negative rates going out to January 2021 and December 2020 and February 2021. The Fed funds rate futures were pricing in negative rates. That's what's pushing this market up. Fundamentals are looking bad, but inflationary pressures, Federal Reserve is doing more quantitative easing. You have situations of rate cuts, more fiscal stimulus, with all these inflationary pressures are pushing a melt up in this market. And people are saying don't fight the Fed, and so they're buying up the market. Well, that's true, yes, don't fight the Fed, but here's the thing. People could have said that right here at the market top. People could have said don't fight the Fed because the Fed had done rate cuts before that, and people could have said don't fight the Fed. The market's not going to go down because the Fed did rate cuts before. This is going to do rate cuts again. True, yes, they did do rate cuts, but you still had the market slipping down that much. So I'm not exactly buying the whole don't fight the Fed thing. I never really buy that because you don't buy a garbage company just because you expect the Fed to go and do more quantitative easing and you expect fiscal stimulus to bail you out. So here's what I'm looking at. We have leading and we have lagging sectors. So with the macro information that we already know, we have leading and lagging sectors. QQQ is one of the leading sectors. If we look on QQQ, we're seeing that it's basically almost at all-time highs. It just has to possibly fill this gap right here, and then it gets close to getting to all-time highs. What about other sectors? Well, XLK is basically the same thing. XLK is a technology sector, QQQ, its own index, but it's basically a technology index. You're seeing the same exact thing. You're seeing this gap likely gets filled, and then maybe some resistance, but it's really close to all-time highs. So we have leading areas in the market like this, and then we have laggards. What are the laggards? Well, XLF is a laggard. Clearly, big down move, small bounce, and this is all you're seeing. And some people are actually saying at the end of the day that all this is that this might actually be somewhat of a head and shoulders pattern like this. Who knows if that's going to play out, but that's something to watch out for is that you're having massive, and this has been happening for a long time, but you're having massive divergence in the market. You're having a situation where some of the sectors are doing great, other sectors are doing terrible. And why is this happening? Well, first off, as I said, the whole market altogether. So we can look at the market as a whole, look at the SPX. It has had some trouble right here getting above that 61.8 fib retracement level. We'll see if it gets above that. I don't think it will. But the market as a whole is going up because of all the monetary fiscal policy and the loose monetary fiscal policy that's happening. But certain sectors like technology are going up as if it's a good thing for them that all this fiscal and monetary policy is happening. All of this happening is because all the monetary fiscal policy is happening because the economy is bad. But why is the tech sector going up more than everybody else? Because, and this is irrational on the market's part, and I've said that before, this is irrational for the market to say this, but the market is looking at these tech sector names as if they're safe havens. So instead of buying up gold, instead of buying up bonds have been down. Gold has been down. Or gold is up, but it's not up as much as it should be. Silver is down. So instead of buying up your traditional safe havens, people are starting to see technology, things like Zoom or Facebook, as a profitable business to go into during the downturn. And I just think that's absolutely irrational because, as we've been talking about on this channel for quite a while, is that coronavirus is simply the pin that pricked the bubble. Coronavirus, it's just a problem that revealed the larger problem. And so tech sector names are absolutely something that you should not be buying up. These names are trading for, oftentimes these names are unprofitable, and many of the names are trading for 100 times earnings. These are not cheap names. There's definitely not safe havens. So, with that said, the market should be heading into gold, silver, possibly bonds with the inflation risk taken into account. But it's seeing it irrationally, and it's saying that in the technology sector, it's starting to see it as a safe haven. And I honestly think that's irrational, but we have to respect that. So, going into it, what are some trades that I'm looking at to take this on? Well, here's the first thing. Trading is not about market direction. Trading is about strategy. So you don't need to know whether the market will go up, down, or stay sideways to make money. You need to have a strategy where if it goes up, if it goes down, if it stays sideways, you make money. And that's what I'll try to do with these trades today, where I'll have a backup plan, and even if I'm wrong on direction, I'll try to make money. So the first one is XLK. So this one's clearly past a 50% retracement. As I said, it has this big gap. Gaps, in technical terms, are when you have big overnight action that is very illiquid, that creates an area where you don't have much support or resistance, and the price can fly straight up or straight down right through it. And so I definitely want to take that on. But here's the thing. Many people would just buy XLK. XLK, if you buy XLK, you have $94.78 of downside risk. So people would then say, okay, well, if I'm not that confident, I'm just going to buy calls. Well, that's still very expensive. Buying calls in this market is going to cost you, even a call that expires 4 days from now is going to cost you 4 or 5% of the underlying value. So that's still very expensive. So what you try to do when you're not as confident, when the market has already rallied up a lot, we already saw this big rally, and there might be a pullback, and it might not even fill that gap. So when you're not as confident that it's going to fill the gap, you put yourself in a situation where you risk a smaller amount to make that bet. How can you risk a smaller amount? You could definitely do a butterfly spread. That's one of the things where you can risk a smaller amount to bet that XLK would go up. A butterfly spread, though, still costs money. It's still theta negative. It still works against time decay. So what if we put in a trade that is theta positive, or at least theta neutral? And I have a trade for you on XLK. It's a broken wing butterfly, May 22, 2020 expiration, long 94 calls, short 2, so quantity 2, 96.5 calls, long 98.5 calls. So what's a butterfly? I think most people know what a butterfly spread is, but I'll go on the side and I'll just show you what it should look like. So let's say you have a stock that is at $100 right now. So right now it is at $100. What you really do in a butterfly spread, or an iron butterfly, which is a synthetic equivalent, is that you sell the spread and you sell this spread, or you can buy a in-the-money debit spread, which is really just a synthetic of selling a out-of-the-money credit spread. If I buy a in-the-money put debit spread, it is a synthetic equivalent of me selling an out-of-the-money call credit spread. So I go ahead and I do that, and basically, if it's at $100, this might be $105, and this might be $95. So this is a normal butterfly, where you sell the butterfly, or well, it's actually considered buying a butterfly, selling an iron butterfly, depends how you do the trade structure, but your short premium right here, where you're hoping that, here's a payoff diagram. If the stock price stays at $100, which would be right here, $100, then you will have max profit. If it goes to 105, you're going to have max loss, and if it goes to 95, you're going to have max loss again. So that's what the trade is at the end of the day, is that it's a way to make a bet that the stock price will go to a certain level and stay there. How will people use butterflies in a directional manner, though? This is if you want to collect some premium. How do you use it in a directional manner? Because obviously calls are very expensive, call spreads are expensive. Buying the stock is too risky because you have all that downside risk. Buying the stock and buying a put is still very expensive, and it's basically a synthetic equivalent to just buying a call. So what do you do to now reduce that downside risk? You can buy the butterfly, and here's how you would buy the butterfly and make a directional bet. If the stock is at $100, and you think it's going to go up to 105 and fill a gap up at 105, but then it's going to stop at 105 and not go higher, then there's going to be a 105 strike, 105, and then there's going to be a 110 strike, 110 up here. So what you're going to do with this trade is that, let me just zoom out on this. So 100, 105, 110. You're going to now do a butterfly, but instead now the stock is at 100, so now you move the whole butterfly up. Now your butterfly is not a theta positive position, it's a theta negative position, and what you're really going to do is that you hope that the stock price goes up a little bit and fills this gap right here that we saw in the chart, but it doesn't go up a lot. And here's how the payoff diagram is going to look. It's going to look like this, roughly like that, where you have $100 down here, and then you have 105 right here, and then you have 110 right here. So you do this trade in such a manner where if it goes up a little, you get to max profit, but if it goes up a lot, your spread is worth 0 and you're at break even. Now, why would you do this over a vertical? In a vertical, if it gets to 105, then you're at max profit, but then when it goes above 105, you don't lose any extra money, but you don't make any extra money. Why would you do a trade where when it goes up too much, you lose more money? Well, here's the thing. In this situation, you're only going to have to pay maybe 1/3 of the stock price to put this trade on with a butterfly spread, but vertical spreads cost a lot more, and if you're not as confident with the vertical spread, it's going to cost 5% of the stock price to put the trade on. So that's why we like using butterfly spreads or a synthetic equivalent or something along those lines, like a broken wing butterfly. And so using a trade like this, and so you're only risking one-third of the percent of the stock price to then make that bet. And that's a lot better, actually, right there. And if it goes up to 105, and if you think it's going to keep on going higher to 110, you can make trade adjustments along the way. Like you could have another butterfly spread now where the stock is now at $105. So let's say that the stock is at 105, and now you realize you actually do think it's going to get to 110. You can put on another butterfly spread just like that, where right here at 105, you put on another butterfly spread that has max profit at 110, and that will make money while this side of this other butterfly will lose money. And so you're able to do different trade adjustments. And that's why you like to use these spreads. It's a lot cheaper to use these spreads. You're risking 1/3 of the stock price. And on top of that, it's an efficient way to make a bet. And even if you're wrong, you can do trade adjustments to make yourself right. So, looking right there, that's just something that you should look out for. But what are we doing? We're doing a broken wing butterfly. So for those of you who aren't familiar with a broken wing butterfly, it's similar, but it's not. It's a butterfly. You have the two wings of the butterfly. Since a butterfly is just two vertical spreads smushed together, it's similar to that, except one of the vertical spreads is a lot larger than the other vertical spread. That's what we call a broken wing. The wings are broken because one wing is larger than the other. So now you're in a situation where you're making a directional bet, because remember, butterflies can be used as two things. Butterflies can be used to make a cheap directional bet that you don't have too much confidence in. We're risking 1/3 of the percent of the stock price, even in a volatile market like this. Or they can be used to collect premium. Now, if you're just collecting premium, then a normal butterfly is better. But if you're going ahead and you want to put yourself in a situation where you want to make a directional bet for a cheap amount, you could use a normal butterfly or you can use a broken wing butterfly. Now, in a normal butterfly, worst case scenario, if the market starts to go against you and starts to go down, right here in XLK, you lose 1/3% of the stock price. What if we put ourselves in a position where we can maybe make a small amount or at least get to break even? Well, then there's a broken wing butterfly. What's a broken wing butterfly? Well, let's say something is at $100 right now. And then 105 is where we think it's going to go. And then we'll do another vertical, but this time this vertical is going to be a lot larger. And this side of the vertical will be at 115, $115. So now we're creating a spread where you have a butterfly spread that has a broken wing where it's theta neutral, so you're not working with time, but you're not working against it. So even if it stays sideways or if it starts to go down from 100, you still don't lose money, and you might actually make a little money if you can squeeze a little money out of there and make it positive, theta positive. And this is what I mean. Be strategic in a way in which you can make money even when everything goes against you. So this is a perfect example of that. So we've done a similar trade on XLK. In the payoff diagram, here's how the risk graph would work. You make a little bit, so 100 right here, 105, and then the max loss would come like this, where 115 would be right here. And so if it goes up too much, you do lose money. And so there's some risk and rewards to this. The reward is at a theta neutral, and it's vega neutral, so volatility crush doesn't hurt you, and time decay doesn't hurt you, and if you're wrong and it just starts going against you completely, you don't lose anything. So there's a good side of it, but then the bad side is that you actually have, if it goes up too much, you have some risk right here. But here's the great thing. As I said, you need to be strategic, so you can set up a way in which you're able to do a trade adjustment where even if it goes up too much, you don't lose money. Because we can take that spread, and then we can do another broken wing butterfly, and we can try to mitigate the other broken wing butterfly. And so I think this is a good trade right here, and this is why I'm doing an XLK. You got to be strategic, where even if you're wrong, you make money. And that's what we're here to do. And we just had the market open right here. XLK is down 0.75%. We'll see how market open works. But that's how you want to go about doing these things, where you want to put yourself in a situation where you can make money even if you're wrong, and put trade adjustments in to eventually end up making money no matter what eventually happens. So, looking at that right there, I'll just clear those drawings. And this is what's happening to the market right now. So XLK, as I said, I want to put that trade on. I want to put a similar trade on QQQ. It's another technology index. May 22nd, 2020, expiration, long 224 calls, long 237 calls, short quantity 228 calls. So going on to QQQ, we are seeing a similar situation with that gap right there. We have a gap right here. We want to fill that gap, but I think it might face some resistance after that. If it doesn't, if it keeps on going up with the broken wing butterfly, as I said, it's a strategic trade. And as a trader, your job is not to be directional and try to find whether the market will go up or down. Your job is to be strategic and try to find a way, even if the market goes up or the market goes down, or if the market stays sideways, you make money no matter what. That's what your job is. So you need to be more strategic, less directional. That's what these trades are going to do. And so I'm not that confident in the trade, or I'm not that confident in the direction, and that's why I put on that trade, because it's a trade that you put on where you risk a small amount and you can make money really no matter what happens. So you got to be strategic, not directional. So don't worry about market direction, worry about strategy. Okay, so now let's talk about those laggards, IWM, KRE, XLF. So let's go to IWM, and here's the thing about IWM. We can go out onto a weekly chart, and we can actually see that while everybody else in 2019 was making higher highs and getting to all-time record highs, the IWM was not. It was a laggard. The American economy is a laggard over the international economy, and it's, for a long time, it was under the rug. It wasn't revealed, but now it's starting to get revealed right there. And this is why overall, longer term, I'm bearish on IWM. Just the recovery for IWM was not as good as it was for the others, and the crash severely hurt IWM, but then later on you had a situation where IWM couldn't even make higher highs. The American economy could not make higher highs versus the international economy. So, with that said, it's a lagging sector and has been a laggard for a very long time. What about XLF? Well, XLF, we can take a look at that, has been a laggard for a very long time. And really, it didn't make too much of a high right there, and it clearly, right here, you actually had a situation where there's a triple top, or maybe even a quadruple top, where you had this top, and then these tops right here. So it's even lower than where it used to be during the subprime mortgage bubble. So this right here is a laggard, and it has been a laggard for a very long time. So we would be looking to be more bearish on this than bullish. And it is below these 2018 lows. So that's another one right there. And remember, this is the international financial sector or the international banking sector. And in the international banking sector, what's happening in the banking sector in general is that you're in a situation where these oil companies had bonds, and who is holding those bonds? The financial sector. Subprime mortgages in 2006, 2007, 2008. Who is holding them? The financial sector. The financial sector is the weakest because they're the ones who are holding the dirty paper. They're the ones who are holding these worthless bonds, the junk bonds. They're all being held by the financial sector, and that's why they're always getting pulled down. And that's why the financial sector oftentimes trades at 5 times earnings. And that may seem really cheap, but it's not, because the earnings are so risky. They come from all those loans that they give out, which are subprime. So the earnings can go away at any moment, and so the quality of the earnings are not good. What about KRE? KRE is even worse, because the KRE is a regional banking sector, and these ones are the smaller banks. These ones are the ones that are really hurt when things go bad. So looking at the KRE, it didn't have much of a recovery, but we can actually go back, and we can see even if you invested in the KRE way back in 2006, you would still be down to this day, and it really didn't make too much of a high, and its all-time high was in May of 2018. And so again, it's a laggard sector, and this is because these are the small banks. These are even worse. At least the larger banks, they're going to give money to larger institutions that might have more cash, institutions that have a better balance sheet. KRE, these are the smaller regional banks. They're giving money to absolutely tiny institutions that have almost no extra cash, very risky business models, and that's who they're going to, are people in the KRE. And also the KRE, since the regional banks are less likely to get bailed out than the international banks. As a result, that risk taken into account, so oftentimes you find companies in the KRE trading for 1 times earnings, but that's absolutely normal because these companies are the worst of the worst. They're even worse than the ones in XLF because they're the regional banks. And this is a terrible index, and it has been a terrible ETF for years and years and years, because this was the one that got hurt the most throughout the financial crisis and had a high in May of 2018 and never got to a new high after that. So that's something to look out for right there. And what is my backup plan? Obviously, I told you my backup plan for the leaders, the XLK, the QQQ, the tech sector. What is my backup plan for the laggards? IWM, KRE, XLF. Here are the trades right here. What is my backup plan? Well, right here on all of these trades, you can see there are different expirations on some of these, but on all of these trades, we are doing a call spread. We're selling a vertical call spread. My backup plan is that even if it rallies up, I gave them a good ways to rally up. I think for a lot of them, I gave them like 10%. So it would take another 10% push within the next 2 weeks. And I think for KRE, a little less since it expires in just 4 days. But they would have to have a big up push, which is very unlikely. But on top of that, if that does happen, we have our backup plan, which is that we're going to sell a put spread, and we're going to turn it into an iron butterfly. And so you can always do that, or turn it into an iron condor. What about our bottom-up trades? So here's where we're going to talk about these. WFC, Wells Fargo. Wells Fargo is down already a good 1.77%. So it's already got down a good ways, so you might actually have to take this trade and adjust some of the strikes, because we said 25, but that's already in the money. But it's still a good good trade. Even if you're not going to put it on, at least you can learn something about this trade. Right here, this is what I was talking about with the directional butterfly. This is a butterfly spread. So you're at $25, and this is a directional butterfly spread with the downside, 25, and then has the 22.5, so 22.5 strike, and then you have the 20 strike. We're betting that Wells Fargo will go down, but not down too much. And if it does go down a lot, I'm not worrying, because we can make adjustments to bet that it will go down further and put another butterfly in. But this is a perfect example of that directional butterfly spread, where you risk a small amount and you put on a butterfly spread, and even if you're wrong, you just lose that very small amount, 1/3 of the stock price on that butterfly spread. So you're going to be in a situation where it's going to look like this, where you have $25 right here, or actually, I should put this back. $25 would actually be right here, so 25 right here, and then you have 22.5 right here, and you have 20 right here. So now you're doing a trade with 25, 22.5, 20. So this means that if it rallies up a little, or if it goes down a little bit, you make max profit, goes down a lot, your trade's worth 0. It's never going to be a losing trade though. What we can do is that we can add another butterfly in. When it gets to 22.5, we think it's going to go down lower. We can just add another butterfly spread in. That's going to look like this, and we can just add another butterfly spread in and try to mitigate the risk in this butterfly spread. But this is a small way to bet on how things are going to play out. And we'll see if you guys can still put this on by the time I release this video, because it is already going down hard right now. But we have that situation right there. And then what about PayPal? PYPL is a ticker symbol. So when it comes to PayPal, what am I looking at? Did have a good rally up. Here's the thing. It's down 0.78%. And PayPal has had a ginormous rally where you can actually look at this on the daily, and you see that it has this ginormous rally, then it has this big gap up open. So what I would expect from here is that probably a bit of a pullback. After this big gap up, I would probably expect a bit of a pullback, but then I think it's going to find some support and it's going to consolidate. So it's going to consolidate sideways for a long period of time from what I'm seeing. And that is the most viable way that I think this trade is going to go. Because what oftentimes happens, many people think that after you have a big up move, that it has an immediate pullback. Not necessarily, it could definitely have that, but not necessarily. What you most of the time see is that you see the staircase in the markets. You see it go up, then you see it go sideways, then you see it go up, then you see it go sideways. And so it goes up, and you see lots of momentum up, and then you see massive volatility expansion, and then afterwards, you're going to have some large consolidation and massive volatility contraction. And then once again, volatility expansion, volatility contraction, volatility expansion, volatility contraction. And you see that again and again and again. And so yes, it could have a minor pullback, but then it goes higher from there. But I think for something like this, it's going to have major consolidation. It's going to go through an equilibrium pattern. An equilibrium pattern means that after you have a big up move, you generally tend to consolidate, come down, go up, come down, go up. Then you tend to get this tightening range right here where it just consolidates massively. And you see inside bar after inside bar after inside bar. And that's what's likely going to happen to PayPal right here. And so what's my trade take that on? This is the premium collecting butterfly that I was talking about. So I'm doing about a lot of butterflies in these trades today. But this is the premium collecting butterfly that I was talking about. This is a butterfly where if you have, let's go back to our example we're talking about with a $100 stock. So you have your stock that's $100. This is the butterfly that is not making a directional bet. This is a delta neutral butterfly where then you have 110. And of course, this is just an example of any arbitrary underlying. And then you have 90. So this butterfly spread right here is if the stock is at $100 and you're betting that it won't go up too much or down too much. So this right here is a premium collection type butterfly that we were talking about beforehand, where you do a butterfly and you hope to collect some premium and hope that it doesn't go up too much, but it doesn't go down too much either. And so this is not a directional butterfly spread like the out of the money butterflies, where this is a at the money butterfly spread. And so this is a butterfly spread that is a mild form of premium collection. That's all it really is at the end of the day. And so we got a fairly wide butterfly on. Short the 143 puts, short 143 calls, long 138 puts, long 148 calls. It's actually an iron butterfly, not a butterfly. But yeah, iron butterflies, same payoff diagram, just different structures. As I said, a butterfly uses a in-the-money debit spread, which is the same thing as an out-of-money credit spread on the other side. And Iron Butterfly uses the out-of-money credit spreads on both sides instead of an in-the-money debit spread and an out-of-the-money credit spread. But really, at the end of the day, they are just the same thing. Previous trades, NAT covered call, keep that going. Euro NAV long calls, keep that going. TNP long calls, strike and expiration, long June 19, 5 calls. Though we are down on those, what we're going to do on those is that you risk 1% of your portfolio on that. If you want to risk another 1% and buy the 2.5 calls, you can certainly do that. And then SPY, 230 long puts, August expiration, we'll keep those going right there. Other than that, if you have any questions about the trades that we went over, again, what you need to take away today is that it's all about strategy, not about direction. Today I didn't talk too much about direction. I really didn't do a technical analysis. I mean, sure, I talked about some gaps and stuff, but I really didn't do a fundamental analysis. I didn't really talk too much about whether the market is going to go up or down. I did talk a little bit about rates. I did talk a little bit about the gaps right there. But for the most part, there wasn't a big technical or fundamental analysis. What you need to take away is that the most important part is the quantitative analysis. Now, what in the world is a quantitative analysis? You have a fundamental and you have a technical analysis. Fundamental analysis is trying to predict whether the price will go up or down based on fundamentals. Technical analysis usually uses an if-then scenario. If there's a bull break, then you buy. If there's a bear break, then you sell or go sell short. And those try to predict direction. Quantitative analysis is a bit different. It is the analysis of using probabilities, and so you don't know if the market's going to go up or down. Like we did with QQQ. We didn't know whether QQQ was going to go up or down, but we looked at the probabilities and we said, okay, what is the probability of a certain thing playing out, and how can we come up with a high probability trade where even if we're wrong, we make money? And that's what I want you to take away from this video, is that if you're in this market and you're unsure about the technicals or the fundamentals and you're unsure about the direction of the market, try to put on a strategic trade. And I showed you a bunch of strategic trades right here. Try to put strategic trades on where even if you're wrong, you make money. And so like we did with broken wing butterflies, the QQQ broken wing butterflies, for example, those are positive theta. So they're slightly positive theta, not by a lot, by like 20 cents a share. So it's not a lot, but they're slightly positive theta. So if it completely goes against us, we make 20 cents a share, no big deal. That's basically just break even. If it goes up, then we make money. If it goes up a lot, we can do a trade adjustment and still make money. So try to put yourself in a situation where you have high probabilities, small risk, high reward. That's what you ultimately need to take away from this video. I didn't talk a lot of fundamentals. I didn't talk a lot of technicals. Ultimately, what I said was that come up with a high probability scenario like we did on the leaders and laggards, where on the laggards, we're selling call spreads. If things go against us, we sell a put spread. We turn into an iron butterfly or an iron condor, and we go from there. And on the leaders, we can do more butterflies with our broken wing butterflies and twist the payoff diagram however we want. And with the bottom up trades, with the Wells Fargo trade, you're risking a small amount right there for a butterfly spread. And again, with a butterfly spread, it's better than just buying a call. When you buy a call, you're risking 5% of the stock price, especially if it's volatile. If you're buying call spread, and that's just if it expires in a week. If it expires a month or 2 months from now, like this July one does on Wells Fargo, then you're risking a lot more. And even a call spread, you're risking 10% of the stock price if it expires 2 months from now. The butterfly, though, you're risking a very small amount. And so you try to do trades like this where you risk a small amount to make a larger amount, and simultaneously your probabilities are high, and you try to stress test the trade and try to say, worst case scenario, what should I do? And you come out strong from that. And of course, a PayPal trade too. So we have all these different trades right here. Really, technical fundamentals, yeah, sure, they're important, but the most important thing is quantitative. It is the understanding of the math behind the trades, the understanding of if I stress test this trade, what will happen, the understanding of the probabilities behind the trades, the statistical risk, the statistical reward, the statistics behind the whole trade, and how things are going to play out, worst and best case scenario, and stress testing that trade is the most important thing. So that's all I really want you to take away from this video, is that am I confident where the market will go? Short term, I do think that we will on the laggards, or on the leaders, see it go and fill that. But long term, I do think over the next couple of months, we will go down. With that said, though, I'm not that confident, so I come up with a trade where even if I'm wrong, I make money. And that's what your job is as a trader, is to make money even when you're wrong. And so that's what I want you guys to take away from this video. Be strategic, less directional. Don't care about the direction of the underlying. Care about the strategy that you're using on the underlying. Other than that, if you guys have any questions about the trades that we had today, if you're unsure about how they exactly work, With this fast-moving market, if I put out a video, the trades might you might have to change the strikes on trades. You might not even be able to use that trade again um, by the time the video comes out. So just watch out for that right there. And if you have any questions, though, go ahead and ask me. I try to answer all the questions in the comments section. And other than that, if you guys like these sorts of videos, just tell me and go ahead and subscribe and give this video a like. Other than that, thank you for watching.